Hello everyone, and welcome to my second video on algorithmic trading with Zorro Trader. The title of this video is Using the Stop Loss on the Golden Cross. And the reason for this funny title is that in the previous video, actually the first one, we did talk about the Golden Cross strategy and implemented it and tested it, but we never used a stop loss during our testing. And I wanted to show you how to first implement the stop loss in Zoro, and I want you to see what happens to the result of a strategy when you are making use of stop losses, and maybe that will help you understand why some people are for them, some people are against them, and so on and so forth. But first, let me remind you what that strategy was, so you don't have to go and see the first video again. So the strategy, the Golden Cross and the Death Cross strategy, the strategy makes use of two moving averages. A slow one, like this one, magenta one here, it's a 200 days moving average, and a fast one, this green one here, it's a 50 days moving average. When the fast moving average crosses above the slow moving average, this is called a Golden Cross, and basically you enter a long position and you hold it until a death cross occurs, when the fast moving average crosses below the slow moving average. And when that happens, you liquidate the long position, right, and you immediately enter a short position. So this is a long short strategy. We implemented it in just a few lines of code, and I told you that Zoro is great with that, and you know it doesn't require a lot of coding to implement strategies, right? And if you remember, everything that happens in Zoro happens in this inside of this run function, right, which is called every single time when a new bar comes in. And in our simulation here, the bar period was 140 minutes, which is a full trading day, right? So we are trading the S&P 500 ETF, called as also known as the SPY, the SPY, right? And we're trading it on daily bars at closing prices. So we define three variables here: the closing prices themselves, right, and then the moving averages, you know, short or fast, and then long or slow, right, the 50 days and the 200 days. And then we said, well, if the fast moving average crosses above the slow one, enter long position, and Zoro automatically exits any short positions you may have. And if you get a cross under, then enter a short position, and automatically Zoro closes any long positions that you may have. Okay, and if you recall, when we were running this, right, we ended up, you know, we hit here the test button, right, we ended up here with a loss, actually, right? So we have the result here of our trading strategy, right? It starts in 1995, and it goes up to May 2020, right? So it's by the default period that Zoro uses, the last 5 years, if you don't specify anything else. And here are the trades, right? The dots are the entry and exit points, right? And the color of the trades shows you if it was a profitable trade or an unprofitable trade, right? So this here is a bad long, right? So we don't see the moving averages here. You know, the black line is just the price action, you know, the closing price of the stock. But a golden cross occurred here. However, the price didn't do what we were hoping, and we got a bad long, right? This is a bad short, obviously, right? So we entered the short position here somehow, and the trade went against us, and we lost money, right? Now, if we had a stop loss here, would that have helped? Of course, because we wouldn't have lost so much money, right? If we had a stop loss here, right, like there, right, would that have helped? Yes, because we wouldn't have lost this much money here, this piece, right? Now, this is a successful trade. This is a good long trade, right? We entered at the right time, stock went up, we sold here, and we made some money, and this is a bad short, basically, again, right? So a stop loss right here would have helped. This is a bad long, right? A stop loss someplace, you get the gist of it. So the stop loss in algorithmic trading does pretty much the same thing that it does in manual trading, right? And people call it risk management. I slightly disagree with that. I think risk management is way more than where you place your stop losses. There are people out there who believe that stop losses hurt systems like these. This is a trend following system, and sometimes stop losses help and sometimes they don't, and you'll see in a moment why some people think that. Okay, so in the other video, we went into a lot of more details about how to optimize this, how to make it better, because obviously it's a money-losing strategy, right? So it has an annual return of -4%, which means it loses 4% every year, right? And the Sharpe ratio, right, the measure of risk. So the Sharpe ratio measures the risk of this strategy, right? It's a negative number, right? So this is horrible. This is just a horrible strategy, right? So we found ways in the other video to make it profitable, but this isn't the purpose here. Let's see what happens if we add a stop loss to this terrible strategy. Is it going to make it better or not? I honestly don't expect it to make it better, and you'll understand why, but I expect the stop loss to make this strategy less risky, okay? And it may do both, but remember, you are being told that a stop loss controls your risk, right? A stop loss controls your risk. Well, if that is true, then the Sharpe ratio, which is a measure of risk, right, should decrease, should become positive maybe, or should get better, right? So when you think stop loss, it's not always the case that we're gonna make more money or lose less money, although it can happen. But the key word here is risk. Stop loss, risk, stop loss, risk, right? So we should see some improvement in the Sharpe ratio. Now, that being said, how do we implement a stop loss in Zoro, right? Well, let's think about it. Well, what kind of a stop loss we want, right? We can do two things. Either we can implement a static stop loss, right? A stop loss that is a fixed value, right? A percentage of the price, right? So stop me out of this bad trade if the price goes against me by 5% or 10%, or I mean, I don't want to lose more than 10% on this trade, so stop me out at 10%, right? So this is sort of a static stop, right? It's a value that doesn't change. I mean, it does change in time, but the percentage doesn't change, right? And the other way to implement the stop loss is to use the market conditions in order to determine how narrow or large the stop loss needs to be. And when we say market conditions, right, what we mean by that is primarily volatility, how volatile the markets are during that period, right? Because if the price wiggles a lot during that period of time that we were trading, right, then we need a stop loss that is not very tight, right? We need a stop loss that's further away from the price. While if the market do not wiggle a lot, right, if they wiggle only a little, if the volatility of the market is low, right, then we need a tighter stop loss, because if the price goes up or down in an opposite direction than we thought it will, right, then our stop loss needs to be tighter, because that's probably a trend that works against us, right, that it's starting. So there are, again, two ways. One way, static stop loss. The other way is dynamic stop loss, right? So let's implement a static one here, okay? And I'm gonna use comments here. It's neat. You can comment stuff in Zoro. It's just a note to self, right, or to some other programmer about what you're about to do here. And we're gonna type, static stop loss at 10%. Okay, what that means is pretty much what you can read there, right? So the market goes against me by 10%. I'm gonna get out of this trade, right? Well, look how easy it is to implement this in Zoro. So it's just stop, right? It's a variable. It's an internal Zoro variable, like bar period, right? It doesn't need a type. Zoro already knows the type for its internal variables, right? So it's called stop, right? Unsurprisingly. And stop equals 0.01, right? What is 0.01? It's 10% basically, right? So times price close. Okay. That's it. That's pretty much it. Does this make sense? I guess it should. So it's a very, very simple way to implement a stop loss, right? Okay, so now let's see what happens here. So we save this, and I hope you appreciate how simple it is to implement and execute complicated things in Zoro, because if you had to program this from scratch, all these things plus the stop loss and how it interacts with these things, right? That's a lot going on behind this line of code. Okay, all right, so let's see what happens. So I'm gonna run this now. Let me close these here. So I'm gonna run this now, and let's see what happens. Oh, we lost money again. How cool is that? So let's look at the trades first. Okay, let's look at the trades first. We have a few trades, and none of them is winning. So basically what the stop loss is doing, it is stopping us out of the bad trades very quickly. Okay, and again, I chose this example because a stop loss is about stopping you out of bad trades, not improving your good trades. A stop loss will not make a good trade better. It will just prevent you from losing more in the bad trade. And this is a great example, right? So we have a pretty tight stop. The strategy was unprofitable anyway, but what we can see here is that we're not losing as much money as we were losing before. Okay, nice. And if we look at these results here, right, what we will see is that we have now an annual return of -1%. So we are not losing 4% anymore, we are now losing 1%. So the profitability has improved because we're losing less money, and this is the job of a stop loss, basically, to prevent you from losing more money. So again, we're not making more money, we're losing less. So now we're a little bit more profitable, if you can say so. I mean, the annual return is better, but simply because we're losing less, and that is the job of a stop loss, to help you lose less money. But this is the cool thing. Look at the Sharpe ratio, right? It is now 0. It's not positive, it's 0, it's bad, but we have improved our Sharpe ratio, which means we are risking less. This strategy is less risky in this version with a stop loss than without a stop loss. Okay, I hope this makes sense, and I have to admit I sort of cherry-picked this example because I wanted you to see what happens when you use a stop loss and an unprofitable strategy, and clarify for you that the job of the stop loss is basically to help you lose less money, not to make more money. You're not making more here, you're just losing less. Okay, now we talked about the other technique to set your stops, right? The dynamic one, right? So dynamic stop loss. Okay, well, and I can't type a number here because it's dynamic, it's something that will change all the time, right? And It will change according the volatility of the market, right? And how do we measure volatility? Well, there are many, many more. If you examine the academic literature, you're going to find that 150,000 million, billion, gazillion measures for volatility, and most of them are just esoteric ideas of some people who, you know, have nothing better to do with their time. But again, volatility is how wiggly the market is, and you know, to my mind, the first thing that comes is, you know, to my mind is standard deviation. Why not use that? Well, we're not going to use standard deviation. We're not quants here. We are doing technical trading. We will use a classical technical indicator called the average true range. Okay, the ATR. I am sure that you heard about it, and if you didn't, then please Google it, read about it. It's a well-known indicator, and what it basically tells you is how much did the market wiggle around during the last n periods of time, right? During the last 20 bars, 50 bars, and so on and so forth. So it's basically a measure of volatility. We could have used, I don't know, standard deviation calculated in a rolling fashion like a moving average, but you know, let's stick with what's classical for now. So the stop loss here, what we're going to say is, hey, use ATR, the average true range, for, I don't know, the last, I don't know, 100 days, right? So use the average true range in order to set my stop, and let's multiply it by 2, right? So if the price doesn't go up or down more than 2 times the normal wiggliness of the market during the last 100 days, then stay in the trade, right? If the price goes outside of this, you know, interval, you know, stop me out, because that means the trade works against me, and you know, I don't want to be in that trade anymore. But what matters here, I mean, it's a stop loss, right? Of course, you understand what it is, and now you see how it's calculated. What matters here is that this one is a dynamic stop loss, so it changes with the market conditions, right? And of course, do not forget your semicolon at the end, otherwise you'll get an error. Okay, but now we need to do something here. Why? Because we have stop loss here, stop loss here. Well, what do you think? Which one is going to happen, the static or the dynamic? Well, you don't want to find out at runtime, right? So this is a bad idea. It's a very bad idea in programming to have 2 variables. You know, I mean, in some programming languages, in most programming languages, actually, this one will be the one executed. But good programming practice is to comment out this line here. Okay. So we're going to comment out that line there, and we're going to keep this line here uncommented, so it will get executed. This doesn't get executed. This doesn't get executed. This doesn't get executed. Everything that's commented, right? Okay. This one, I'm sorry for those of you who are programmers and know these things, but these are videos for beginners who probably don't know these things. So, okay, so we have now a stop loss that is dynamically calculated as twice the average true range for the last 100 days. Why twice and why 100 days? I have no idea, guys. I just made this up. I'm making this up as I go along. So you know, 100 is somewhere between 500 and 200, and twice because, you know, if you would say 3 times, you know, that's a really volatile market, really crazy. So well, we can experiment with the value, see what happens. But let's see what happens now. So we are going to run this in Zoro, and whoa, what just happened here? We are losing as much money as without a stop loss. We are losing as much money as without a stop loss. There are longer trades than in the past, right? The trades that we had with a static stop loss, they all had the exact same length, right? 1%, 10%, whatever we did, right? So those trades were of the same length. Here, because the stop loss is dynamic, right? Some trades are shorter than others. When the market is very volatile, look at this, right? What a huge wiggle here, right? When the market is volatile, the average true range is large, and then we get longer stops, right? So this is a long stop. Stop or trade, whatever you want to call it, they are trades, right? You enter the trade, you exit it by being stopped out, but they're still trades. So look, you have a long trade here that went a short trade here that went bad, and you have a long trade here that went bad, but these are longer than these, and that's the explanation why we are losing as much money as in the beginning, and we're losing more than by using a static stop loss. Now, that being said, that doesn't make static stop losses better than dynamic stop losses. It's just that in this situation it turned out like that. And I picked this example, why? Because what I wanted you to see is that although we are losing more money, the annual return is now again -4, right? The Sharpe ratio is still 0, like with the static stop loss, right? The point I was trying to make with this example is that the job of the stop loss is to improve your risk, okay? So the Sharpe ratio is 0 in the first case of the static stop loss, and it's still 0 in the second case of the dynamic stop loss, right? That is the job of the stop loss, and it does it well. And the annual return, so making the strategy more profitable or losing less money, that is not necessarily, the profitability, annual return of the strategy is not, the job of the stop loss. Making it more profitable, it's not what the stop loss does, right? The stop loss is about risk, and the Sharpe ratio is the measure of risk. And here we see that both stops, dynamic and static, they do a great job at reducing the risk. They actually bring it to this 0 here, which doesn't mean, guys, that there is no risk. Please don't interpret it like that. It doesn't mean there is no risk. We want to see this a positive number, a high number. But we did better in terms of risk with a stop loss than without a stop loss. Now, well, what happened here, right? If we look at let's look at the result, the graphical result again, right? What happened to all those long trades? Which long trades? Okay, let's comment out the stop loss here, save it, right? And then run this again. So now we are running without the stop loss, right? So what happened to this long, green, beautiful trade that was successful, right? That was profitable. What happened to that, right? Why don't we see? So in the upper part of the screen, let me organize my real estate here real quick. Just 1 second. Okay, let's make it more visible, right? So in the upper part of the screen up here, this is the result of the simulation with the dynamic stop loss, right? And you remember that the only difference is versus the static is that, with the static stop loss, these trades have equal lengths, while here, because the stop loss is calculated dynamically, you get trades of different lengths. But what happened to this trade here, right? This one here was a bad trade, right? And we got stopped out, as you can see, right? We got stopped at 10%, right? Here we're losing more than 10%, right? Here, you remember that trade, right? This is without the stop loss. The lower part of the screen, no stop loss, right? Here we had a bad short, right? Oh, the stop loss worked, right? The stop loss worked. So we lost less with the stop loss than without it, right? No matter what kind of stop loss, static or dynamic. However, look what happens here. We had a nice long trade, and it's missing here. Why? Because we got stopped out. Okay, so this is something that looks like a bad long, a long that turned bad, and it is because we got stopped out, right? So time has passed. We entered the trade at the right time. Time has passed, but the price worked against us initially, right? Initially, the price worked against us, and because the stop loss was too tight, although it was calculated, dynamically, right? And it was the same in the first example with the statical one. Because the stop loss was too tight, the price couldn't go against us too much, right? If you see here, price didn't go up, it went down. We were in a long trade, and then the stop triggered. And if it wouldn't have triggered here, if we had, a larger stop loss, probably would have triggered here. So, so we lost the only, not the most, the only profitable trade that this strategy generated. Okay, and this is the big problem with stop losses. They cut your losses, they minimize your risk, but they also remove some very, very good trades. Okay, this was a really good trade. It is by accident, actually, that I think that these two strategies sort of lose the same amount of money, right? So remember, when you are doing something like trend following, when something like this, either with moving averages or with momentum or with something else, keep a sharp eye on your stops, and try to figure out what works and what doesn't, because this does happen. So a stop loss that is too narrow will kill some of your best trades in situations like these. Okay, I hope you understand what I'm trying to tell you here. If not, please feel free to ask questions in the comments section. And if you like this video, of course, don't forget to like it. Click the like button down there, or subscribe to this channel. Thank you very much, and happy trading.